This is the sound of the tax agency knocking on your door. Most people are either too aggressive or too conservative. Either way, it costs money. Here, we explain what the law actually allows, so you keep what is rightfully yours and meet your obligations with confidence. Everyone's situation is different. Let us get yours right.
Welcome back to our OBBA comparison. This is City again. Today, we are diving into the detail for personal tax and all of things your accountant might want you to know.
Hope this is not as deep as the ocean floor. I cannot help you to interpret if I fell asleep and become the iceberg.
No worries. Although I sound like this, I am still your Asian accountant who helps you to understand the mechanic. Or we can just walk in your shoes for your tax journey so you don't fall asleep. If this bores you, blame your own wallet for caring more about coffee than cash, or you just cannot afford the Chinese labor here. Last time, we had a brief idea on how OBBA could be a strategy to retain the talent, as the middle class feels less screwed by the government. I guess I was wrong after that H-1B visa increase.
Guess we won't be going to the US with our current license under the H-1B then, unless there are employers who want to pay that $100K.
As Canadians, we used to have the option of the TN visa under USMCA if they're employers who need an RN and a Canadian CPA. And we don't need to get the green card and citizenship and be taxed the worldwide income as U.S. citizen.
I guess Donald is trying to drive out the Indian coders then?
Well, Christopher must have time traveled and hit the North America by accident to say he saw the Indians.
So far, we haven't seen tariff on labor yet. I guess we will continue to see Indian labor putting in their time for an U.S. project from India.
You're exposing on what most of the Kim friends are doing right now. Today, we're zooming into the detail, tips, overtime, child and senior credits and benefit, vehicle loan interest deductions, and other benefits you should pocket before it is too late.
So we are starting with the section I want to know the less, since we are not expecting any tips.
I think to start with the personal tax, we would need to know how personal tax works.
That sounds even more boring.
I mean, you still need to know the three basic components in order to put the necessary money back into your pocket.
Just 3? I think I can bear that rat.
Yes, just 3. Income, deductions, and tax credits. And what you need to know the most are the expenses and tax credit, which are things you use to reduce your tax payable.
And probably, in the sample cases, everyone would know the income from their T4 in Canada or W2 in the US. And if you are rich enough in Canada, you're probably getting some T5, T3, or T5008.
You're right, so we don't want to complicate the things and should go directly to the deductions and tax credits. The deductions, such as the expenses and deduction allowed in tax return, that would bring you to your net income for tax purpose. Here, it goes slightly different for Canadians and our neighbor in the South. For Canadians, think about RSP, pensions registered under your employer, fees and interest on your investment account, and your childcare expenses, and then the movie expenses will you relocate closer to your employer.
There would be more expenses to reduce your income if you are self-employed, renting on your house, or if you are required to incur expenses that are not reimbursed by your employer. Always ask your accountant, or this Asian accountant will ask you.
In the U.S., although I am not the best to talk about it, by looking at the 1044 and Schedule A, if you are not taking the standard deduction of $15,750 in 2025, they can itemize the deduction of the medical expense, your estate tax, and then the state and local real estate tax, home mortgage interest you pay over your investment, and the gifts to charity that might go to the people you intend to help.
Also, the casualty and theft loss. However, this loss must be from a federally declared disaster, not someone picking cotton and picking apple from your pocket.
Theoretically, you would probably take the standard unless you think the sum of these expenses would be more than the standard amount that you are taking. But this list seems so comprehensive in comparison to ours.
In Canada, majority of that list would show up as tax credits, so rich people cannot spend more and deduct more because of the marginal setting of the tax calculation.
What do you mean by marginal setting?
I know most people thinking about a single rate over their income as the tax they would need to pay, but it is more like a Japanese buffet owned by Chinese or Koreans. The more sashimi you order, the less you get on the later plate. Your after-tax income reduces more on the later money you make. Assuming you're making $100,000, in Canada, the federal income tax for 2024 will be level 1 income, $55,867 times 15%, and then add on your level 2 tax, which is the remaining $44,133 times 20.5%, totaling to $17,427 instead of a direct 22.5%, resulting in $20,500 tax. In the US, the federal tax for 2024 will be level 1 income, $11,600 times 10%. Add on the level 2 income of $35,550 times 12%, then your level 3 tax of remaining $52,850 times 22%. These will total to $17,053. It will not be a direct 22% and hit you with a $22K bill. Also, just a correction from last episode, the tax rate did not change due to OBBA. Instead, OBBA just makes permanent the tax rate under the Tax Cuts and Jobs Act from 2018. That act also has the signature of Donald.
Too much math. My head is melting.
I think this is the only boring part of today. I will stop these calculations from now. But what we talked about just to show how your Japanese buffet giving you less sashimi when you ordered too much.
Should we head back to the tax credit then?
In the tax credit, there are non-refundable and refundable tax credit. It results in whether you can get additional money or just to take back the money that you paid.
What do you mean the money you paid?
I think a lot of people have the concept that the more they received in the tax refund, the better. However, it is the opposite. That's the money your employer helped the government hold and then paid to the government. If you think about it, those numbers on your W-2 and T4 are actually the interest-free loan that you provided to your government for a year. So if you get less back or need to make a payment, that means you have the money available or loan from your government interest-free to put into some investment that can give you better return.
Interesting concept. Does that work for a corporation as well?
In Canada, the corporate would not need to pay for the sales tax or corporate tax on a predetermined basis if the company is not earning that much. But if certain threshold is hit, you would need to file the sales tax on a monthly basis, and you would need to make installments for corporate tax on a monthly basis as well. This could then result in an overpayment if you are having less net income for the upcoming year. But who want their company to get worse, right?
I will wait for your detail on corporate tax for the next episode. Otherwise, it is just too much for my brain today. Let's get back to the personal tax.
Where were we before you rudely interrupt? Oh, the tax credit. So the non-refundable tax credits are the tax credits that you can use to reduce the tax, but if it is more than the tax you need to pay, it would not be refunded. On the other hand, the refundable tax credit would provide you with the refund when the amount is above the tax you would need to pay.
As that being said, the non-refundable tax credits in the US are based on several different forms and get you a certain amount. The Canadian non-refundable tax credits are some specific items that times the lowest tax rate, which is 15% for 2024, 14.5% for 2025, and hopefully 14% or less in 2026. Some of the non-refundable tax credits there are personal amount, which is similar to the standard deduction in the South, CPP and EI that are taken away from your paychecks, Canadian amount if you work in Canada, tuition amount for this year and carry forward from prior years, medical expenses that is difficult to claim, and so on. As always, ask us for the details.
For the refundable tax credit, the items are very limited. They are basically the amount that you paid already. The tax that is withheld by your employer to the government from your paychecks. Overpayments over the CPP and EI from your paychecks. The remaining are mostly miscellaneous unless you are in certain occupations.
Seems like there are quite a lot of things that are deducted by your employers and remitted to the government then.
Yes, so sometimes it could be quite important that you keep your pay stub and review if anything that seems odd, which could be error from your employer or the payroll processing company. Some of these could have an impact on the tax situation you're in. They are usually right, but mistake could happen.
I think we can back to our comparison then.
Yes, so once we know about the difference between the deductions and tax credit,
We could work faster and refocus on our topic for today then. From last episode, we learned about the deductions that are under OBBBA, which are tips deductions, overtime premium deductions, increased senior deduction, and vehicle loan interest deduction. Then in the tax credit, there is only the increased child tax credit.
If I learn from what you just said early on, that means most of them would be a direct deduction over your income, so the impact on the tax would be significant.
That is correct. As the higher the tax bracket you are at, the more tax you are saving through the deduction in the income.
But most of them would still be phased out if you were earning tons of money, which probably not applicable for the middle class and the rich people with their tax saving strategies. So theoretically, is that really phased out?
Maybe we should look at some public companies' director compensations and see what kind of tax saving strategies they have. Heading back to the tip deduction, this allows the qualified tip deduction of $25,000 each year until Donald finishes term. At the same time, the phase-out starts when your earnings exceed $150,000.
So if you're bussing tables in Miami and making $25K in tips, you can wipe out that entire tip income from your taxable wages.
Actually, no, because they would need to pay the tax over the full tip amount if their employer reported that correctly. The IRS defines tips as amounts that a customer decided and voluntarily pays without compulsion and not subject to the store policy. So if the restaurant added the tips where you cannot decide the amount or remove that, then it is not qualified.
After revisiting the detail, is there by any chance that nurse and accountant are able to receive tip and report the deduction?
Obviously, no. We are considered specified service that is excluded from the tax. Maybe I should have a coffee shop at the storefront and an accounting firm at their back. Free accounting and tax service. The client need to buy the coffee with a good tip.
And you say there was a phase out last time, right?
Yes, as the income hit $150K, your deduction will shrink $100 for each $1,000 exceed that. But think about it. What type of service worker would have the earning more than $150K?
Maybe in Vegas? How do we treat tips in Canada, though?
In Canada, if it fly through a credit card machine, then your employer would need to track them and include them in your T4. On the other hand, any coins and bills that are left on the table will still need to be recorded on the tax return. But who would know you are receiving cash tips as long as they don't go into the bank, or maybe just get some winning from Niagara Falls and putting them into your bank account? Small tip, don't launder money for the small tip.
That is inspiring. Are you going to talk about money laundering in the future?
That is probably all accountants' dream, to get that one shot done with cartel. Probably have a better chance to retire than getting a lottery ticket before you get a shot in the head. Unless you get the fistic as Ben Affleck in the movie, I would not recommend all city feds doing that. But with all new ways of money laundering for revenues, we can probably have an update in the future.
And the next rundown would be the $12,500 overtime deduction. Can you break that down for me?
There isn't much doubt about this. The deduction is available for the overtime premium portion, as we mentioned at last episode. Just imagine you are earning $20 per hour. By the way, this is about the minimum wage and more than double of the minimum wage if you are in the Midwest. Yeehaw, I mean. Then under the Labor Act, you will be earning for 1.5 times of your regular wages, $30 per hour. This additional $10 is the premium, and this is the part where I can have the deduction on.
I barely see overtime pay, not gonna lie, but some facilities don't let you show overtime on the timesheet.
Ouch. But eventually in Ontario of Canada, you're getting 1.5 times of overtime pay only if your weekly hours hit over 44 per week. The overtime metric could be good for employees in factories or call centers. Probably not those call centers in India or Cambodia. The deduction could be a tax saver for people that need to work longer. In Canada, your OT is taxable like any regular income, no deduction just yet. We will see anything coming up in the November federal budget.
Next, we got the US child tax credit rises from $2,000 to $2,200 per qualifying child in 2025.
This tax credit starts to phase out at 200K and fully disappear on 244K.
That's $200 more per kid, yeah. You got half a week of groceries there.
One additional thing is that child tax credit is partly refundable, so low-income families can get cash back instead of just paying zero tax.
Canada's Canada Child Benefit is income tested and pays up to about $6,300 per child over 6 and $7,400 per child under 6 annually. As we previously mentioned, it is completely phases out around $220K family income. Guess the parents in Canada get more for each kid, but they just cannot earn as much as our neighbor in order to get the benefit then. Do we have child tax credit that deduct your annual tax similar to the US?
We used to have one, but got replaced with the CCB that we mentioned, so the government would help you to calculate the amount you're getting on an annual basis. However, a single parent with a kid can have the kid as their dependent. The deduction would have the same amount as the personal amount. So let's say if a couple that is not married nor common law with the kid, the parent that is considered to stay with the kid for the year can get the personal amount deduction twice and CCB. At the same time, both parents can get the benefit like HST credit. Instead of one share, they can have two houses considered as their principal resident for the future resident exemption when they sell the house.
Why get married then?
The benefit calculation could be slightly different for married couple or single, but if you are getting that benefit, that means you're not living in Canadian metropolitans. So I don't get the reason to get married in Canada. It's gonna be the true love.
Oh, getting married in Canada must be the act of true love that can thaw the frozen heart.
Don't sue her just yet, Disney. We will try to get more children and friends as your audiences, as long as you don't go overly politically correct.
I feel you are probably the one getting sued. I think we should discuss about the grandparents that bring their grandkids to Disney World. What are they getting out of OBBA?
The senior deduction amount has increased from $1,950 to $6,000 for a taxpayer that is 65 or older. This deduction would start to shrink when the income hit $75K and fully gone after earning $175K.
That sounds like a good amount for the grandparents to get a deduction from the tax and can take their grandkids to Disney World. Or maybe a saving for attending a hospital, I guess.
Probably, and not for Canada since our health are mostly free. And in Canada, we have the age amount at up to $8,790 tax credit, but starts to phase out at around $44K income. For each dollar you earned, the credit is reduced by around 15 cents and fully gone around $102K.
Our seniors face steeper phase-outs but higher initial amounts.
Our seniors can also receive money for the old age security and guaranteed income supplement. Our government tries to help our seniors, and I hope these are not abused and got canceled in the future.
Do you mean abusing a student visa and becoming our Uber Eats driver?
I didn't say that. As part of the benefit in Canada, security or OAS will be demanded a payback if our seniors are having too much income, and just the OAS of itself might be less likely to be abused.
Well, I recently saw there are some people faking the entry date to scam the OAS, and what is the payback there?
Theoretically, since LAS pegs on the number of years of residency in Canada, if my left-hand government of Canada coordinates with my right hand Canada Revenue Agency, then it can easily check the number of years of residency they have in Canada. If you're residing in Canada for more than 183 days, in short, you're a tax resident, this could probably work as the first line of defense. Also, Canada doesn't seem to have a well-established immigration record, so some immigration scam targeted this to avoid the residency requirement for permanent residence and citizenship.
You sound a bit frustrated.
When someone steps in your house without your permission and starts using things owned by you, drum things around, that doesn't sound acceptable. Back to OAS, the amount is prorated based on the number of years resided in Canada divided by 40. So when you're 65 and you stayed in Canada since 25, you're getting the maximum. However, if your income hit 90K, the amount received will be reduced or you'll be required to pay it back. OAS would disappear when our senior has more than 148K in income or 154K if they are older than 75.
That doesn't sound too bad, but you told me that the annual amount would be less than 10,000, right? What else can our seniors receive to get a better living?
Yes, currently the annual amount for the old age security is less than $10,000 annually. However, given the phase out starts on 90K, they can probably withdraw their RSP, which is considered as income to compensate their retirement life. Or on the other hand, there is Guaranteed Income Supplement, or GIS, to give our seniors some additional supports. GIS comes non-taxable and at $1,000 per month.
This sounds like double the fun of OAS and doesn't need to pay tax.
To be honest, this combines with OAS, which is carried to around 20K, which might not be feasible to survive. And if you think about it, any withdrawal from RSP would reduce the GIS. So, gotta pick your poison.
You mentioned there might be some walkarounds?
That is not really a walkaround about using your hard-earned money somewhere else. But we would not talk about it here, but we can have some brainstorm with our clients. But that is not a secret anyway.
Should we go here with the last deduction face-off?
This is not much a face-off since the U.S. measure is dominating, just like how Blue Jays was doing in Game 1 of the World Series.
Are you saying you were just working and watched baseball and left the channel behind?
There's some deadline to catch, but at least we get this finished before the tax return time hit. And I will try to get the next one as soon as possible so I can see what Mark is preparing for us in the new federal budget.
From last week, the last one is the deduction for interest on qualified new vehicle loans. The deduction is up to $10,000 per year for new vehicles made in the USA.
But also, it is for the interest portion of the purchase only. So if you're on a 0% financing, it does not deduct your tax. Assuming that you are on a 3.9% finance for 3 years, in a simple world, it would need to buy a car worth around $250K to max out the deduction. The deduction would phase out on 100K income and gone by 150K.
Buying a car that is more than your income doesn't sound that practical, and the interest that you deduct is what you actually pay. So it is not necessary to fully utilize that, I guess.
First, sure, you don't need to fully utilize that since you will be paying your hard-earned money on interest, which is not allowed under Islamic law that while some of the car might get expensive with the tariff hitting on the car parts, even the car is finally assembled in the US. Also, this would not be for Prius for California since Prius are assembled in Japan.
I think the good thing is the tariff for Japan is 15% in comparison to the 25% to Canada. Does that mean that Tesla will take over California to replace Prius then?
Yes, that's why Elon was quite happy with Donald in the beginning, but I think this is probably a good way to support the US automobile manufacturing. Just now, if you really want to utilize this deduction, you would need to check the VIN before making your purchase.
Does Canada have matching offered to counter?
Canada does not have a similar deduction if you're using the vehicle for personal use. However, if you get the vehicle for business use, some deductions are available as long as you don't buy a crazy expensive car. In short, just buy a car that costs less than $37K. If you want to know more, you can always talk to your accountant or us.
City, all these deductions look great on paper, but what's the catch?
OBBA is just as temporary as adrenaline. They are gone with trial unless extended by Congress. That decreased revenue results in cutting Medicaid and SNAP, as previously mentioned. Well, below-income families would now need to make sure they also have the required work hours.
That is why you say the middle class feel less screwed. They can save a bit of tax money while the low income would not have better food and plate than them.
But I'm not sure if that would result in more zombies on the streets of San Francisco.
I hope that. As long as the benefit abuse in Canada is resolved, I'd be totally okay paying taxes and give out some benefit since the tax between the two countries seems quite similar. I just don't want our hard-earned money paid to someone that doesn't really need all these welfare money. So, City, where are we heading next?
Next time, we will continue to dig a little bit on how the OTBBA impact on the corporation side. We'll unpack permanent corporate rate cuts, R&D incentives, and whether multinational firms will migrate south or better off to stay. We will also unwrap some of the benefit in Canada that we mentioned previously. With the federal budget coming up, we might change our topics slightly to give out a quick update on what kind of beef the Mornigan has for us.
And if you have any questions for accounting or for tax, ask your CPA or us.